Hello, I'm Jake Weinstein on the Asset Allocation Research team at Fidelity Investments. Today, I'd like to share the key insights from our team on the state of the economy and recent market developments. After a shaky start to the year, including geopolitical fears and spiking oil prices, markets recovered in the second quarter. Oil prices fell toward their pre-conflict levels. Artificial intelligence-related investment helped broaden corporate earnings growth, while an improving labor market helped alleviate concerns of an economic slowdown. Despite a constructive macro backdrop, markets are predisposed to potential bouts of volatility as geopolitical and policy uncertainty, inflation persistence, and elevated asset valuations warrant continued emphasis on portfolio diversification. The second quarter of 2026 saw a strong rebound, particularly in information technology stocks, which have demonstrated strong multi-year performance, both in the U.S. and across the globe. Over the last year, technology exposure in the MSCI Emerging Markets Index catapulted from 23% to 43%, driven by Taiwanese and South Korean stocks, which now account for more than half of that index measured by market capitalization. Strong performance from the tech sector draws comparisons to the high-flying markets in the late 1990s, early 2000s, which was another period of rising market concentration. Markets continued to reward AI-related capital investment, incentivizing several notable hyperscalers to ramp up financing. The total expected proceeds from initial public offerings in 2026 are expected to surpass the capital raised during the dot-com frenzy in the late 1990s. The ability of companies to access financing will be critical for both equity and fixed income markets. While it's completely normal for the market to be laser-focused on these near-term themes like AI or large IPOs, the most important factor to assess for the path of asset markets over the next year is the current state of the business cycle. And our view is that the global economy remains in a solid yet unsynchronized expansion, with the U.S. demonstrating mid-cycle dynamics including solid economic activity, early signs of recovery in the labor market, easing credit conditions, accommodative policy, and healthy corporate profits. Other countries remain in various phases of their expansion, driven by local politics and policies. I mentioned earnings as supportive of the U.S. economy, but the improvement in corporate profits has also broadened across the world. Tech-concentrated emerging economies such as South Korea and also the U.S. led the way, but we're also seeing improving earnings in other areas of the world, including Canada, Japan, and Europe. An optimistic earnings outlook underpinned by improving profit margins provides a supportive backdrop for the global business cycle. We can't give a recap of the quarter without talking about the new Federal Reserve Chair, Kevin Warsh, who headed up his first Fed meeting in June. Persistent inflation, a recovering labor market, and efforts to gain credibility contributed to a hawkish tone from the new Fed chair and shifted market expectations from rate cuts at the beginning of the year now to potential rate hikes. However, the outlook for monetary policy and the path of interest rates is highly uncertain, as there are several reasons why the new Fed chair could be patient regarding the Fed's next move, including a weak housing market, struggling low-income consumers, and the potential for AI to ultimately be disinflationary. When we put this all together, the U.S. and global economies are in expansion, labor markets have improved, higher oil prices were not enough to disrupt the cycle, and the corporate sector remains healthy. However, sticky inflation, policy uncertainty, and elevated stock valuations present challenges to the outlook. Therefore, maintaining a well-diversified portfolio remains paramount to achieving your long-term objectives. For more information on our perspectives on the economy and on financial markets, please read our complete quarterly market update at fidelity.com/QMU. Thank you.